There is a moment in every civilization when capital begins to move before the public understands why. It does not announce itself with headlines. It shifts quietly, like pressure building beneath tectonic plates. By the time the tremor reaches the surface, wealth has already relocated, infrastructure has already been built, and the advantage has already been claimed. Today, that pressure is building again. The question is not whether change is coming. The question is whether you understand the asset class forming beneath the surface while most people remain distracted by yesterday's markets. Historically, every dominant asset class has emerged from a structural vulnerability. Oil rose when industrialization demanded dense energy. Real estate surged when urbanization concentrated populations. Technology equities exploded when digital networks reshaped communication and productivity. But in each case, the majority entered late. After infrastructure was laid, standards were set, and early capital had already multiplied. The current shift follows the same pattern, but its foundations are less visible because they are embedded in data infrastructure, energy grids, semiconductor supply chains, and artificial intelligence systems that most people interact with daily but rarely analyze as physical assets. The common misunderstanding is that billionaires are simply buying stocks in artificial intelligence companies. That is surface-level thinking. Public equities are the visible layer, the tip of the iceberg. The real allocation patterns, the movements that matter, are occurring deeper in the stack. Advanced chip fabrication facilities, hyperscale data centers, rare earth mineral supply chains, high-capacity energy storage, quantum computing research, and sovereign-grade cloud infrastructure represent physical and intellectual capital bottlenecks. These are not speculative tokens. They are engineering constraints. And where there is constraint, there is value. The hidden science behind this shift begins with thermodynamics and information theory. Artificial intelligence is not magic, it is computation. Computation requires energy. Energy requires infrastructure. Training large-scale machine learning systems consumes enormous electrical loads measured in megawatts per facility. Data centers now rival small cities in power consumption. Cooling systems, liquid immersion technologies, and grid stabilization mechanisms are no longer auxiliary services. They are core economic drivers. When demand for computational capacity increases exponentially, the real scarcity lies not in software, but in the physical systems enabling it. This is why capital is flowing into semiconductor manufacturing, grid-scale batteries, nuclear microreactors, and transmission upgrades. Evidence supports this trajectory. Over the past decade, capital expenditure on data center infrastructure has grown dramatically, with hyperscale operators investing billions annually into server farms and AI-optimized hardware clusters. Semiconductor fabrication plants require multi-year construction timelines and tens of billions of dollars in upfront capital. Governments are subsidizing domestic chip production because supply chain fragility became undeniable during recent global disruptions. Energy utilities are revising load forecasts upward due to AI-driven consumption increases. These are not speculative signals, they are structural adjustments backed by audited financial disclosures and public infrastructure planning documents. The survival implications are profound, though not in the cinematic sense of collapse, but in economic survivability. When a new foundational layer of the economy forms, individuals and institutions positioned within that layer experience compounding advantage. Those outside it experience relative stagnation. The emerging asset class is not a single ticker symbol. It is computational infrastructure itself. It includes the land under data centers, the intellectual property embedded in AI architectures, the supply contracts securing rare earth elements, and the energy systems powering next-generation processing. This is not about hype cycles. It is about control over capacity. Escalation becomes inevitable as global competition intensifies. Nations recognize that AI capability influences defense systems, economic forecasting, logistics optimization, drug discovery, and cyber resilience. Capital follows strategic necessity. Private investors with long-time horizons move in parallel with national policy because both recognize the same constraints. When electricity demand surges, power generation assets become leverage points. When advanced chips become scarce, fabrication ownership becomes leverage. When data becomes the new oil, storage and processing become extraction fields. The next asset class is not digital in the abstract, it is infrastructural in the concrete. To understand the transition fully, we must examine how previous asset shifts concealed themselves during early stages. Railroads were once dismissed as speculative ventures. Telecommunications towers were considered mundane utilities before wireless data exploded. Cloud computing infrastructure seemed like back-end technical plumbing before it became the backbone of global commerce. Each case followed the same arc: underestimated utility, rapid scaling, infrastructure lock-in, and then concentration of wealth among early allocators. The pattern repeats because human attention lags behind engineering reality. Now the danger lies not in missing a speculative trade, but in misunderstanding systemic reallocation. When capital aggregates around computational infrastructure, it influences labor markets, education systems, and regional development. Cities with cheap, stable power and favorable regulation become hubs. Semiconductor ecosystems cluster geographically due to supply chain interdependence. Research institutions attract funding tied to AI advancements. Entire economic zones reorganize around compute density. Those unaware interpret the surface as volatility. Those analyzing the underlying physics recognize inevitability. There is another overlooked principle: marginal efficiency gains compound at scale. In high-performance computing, small improvements in chip architecture, cooling efficiency, or energy distribution reduce operating costs across millions of processing units. This translates into competitive advantage measured in billions. Investors with engineering literacy recognize that efficiency innovation becomes a moat. The public often sees AI as software creativity. The deeper layer sees it as energy to intelligence conversion efficiency. Whoever optimizes that conversion controls cost structures across industries. Misunderstanding persists because narratives focus on personalities rather than systems. Public discourse elevates individual founders, but infrastructure ownership determines long-term returns. Data centers require land acquisition, water rights for cooling, and grid interconnections negotiated years in advance. Chip plants require ultra-pure water systems and extreme ultraviolet lithography equipment produced by a handful of specialized manufacturers. These dependencies create bottlenecks that are measurable, not speculative. Scarcity underpins value. Evidence of allocation patterns can be observed in capital expenditure reports from major technology firms, sovereign wealth fund disclosures, and private equity placements targeting digital infrastructure. Investment vehicles dedicated to data center real estate investment trusts have expanded. Energy companies are forming partnerships with AI firms to secure long-term supply contracts. Semiconductor equipment manufacturers report multi-year order backlogs. These are quantitative signals of structural migration. The survival implications extend to individuals seeking economic resilience. Understanding that computational infrastructure underlies productivity, growth reframes career and investment decisions. Skills aligned with semiconductor engineering, power systems management, cybersecurity, and AI optimization gain durability. Regions investing in grid modernization and research facilities gain strategic leverage. The asset class is not a trend, it is a layer of civilization forming in real time.
The reality is that the next asset class is not a single stock, not a cryptocurrency, and not a fleeting trend. It is the physical and digital scaffolding that underpins civilization itself. Billionaires are quietly positioning in data centers, semiconductor facilities, renewable energy grids, and secure AI processing infrastructure because they recognize a fundamental principle: control of computation equals control of value. The scarcity of materials, energy, and expertise, coupled with the exponential demand for AI-driven capabilities, creates structural advantages that compound over decades. Understanding this is no longer optional for anyone aiming to survive and thrive in the coming decades. It is a prerequisite for strategic decision-making. Every layer of infrastructure, from raw materials to distributed AI networks, represents leverage, and the more effectively an individual or organization navigates these layers, the greater their resilience and opportunity. As the world accelerates toward an AI-driven economy, complacency will be the costliest mistake. Short-term headlines, market volatility, and surface-level speculation obscure the enduring value embedded in the foundational systems. By analyzing the engineering realities, network effects, and systemic interdependencies, one can see how wealth will consolidate around those who anticipate, build, and protect infrastructure at scale. The lesson is clear. Discipline, foresight, and strategic allocation define true advantage. For those seeking insight into the methods and mindsets of billionaires navigating these transformations, stay engaged, like this video, and subscribe to Billionaires Discipline for more compelling, informative, and high-value content designed to reveal the principles that shape real-world success.